Well, good morning, good afternoon, and good evening, wherever you are, and a very warm welcome to all of you joining us today. My name is Barbara Buchner. I'm the Global Managing Director of Climate Policy Initiative, and I'm very excited to be here with you today and with a fantastic panel. You are here joining us for today's launch of CPI's newest Spotlight report focused on emerging markets and developing economies, which builds on the findings of our Global Landscape of Climate Finance 2025 report that was published earlier this year. So in today's sessions, we will take a deep dive into how emerging markets and developing economies are driving climate investment progress. The report's lead author, Baisa Naran, will highlight regional trends, the growing role of domestic and international capital, and the opportunities to further strengthen flows in emerging markets and developing countries. Well, as we are very fast approaching COP30 in Belém, today's discussion and the particular focus on emerging markets comes at a critical time. I think we all know that emerging markets are home to nearly 90% of the global population. They're on the front lines of climate risk. But at the same time, they are also at the heart of climate opportunity. It's their success, mobilizing finance for clean energy, for resilience and innovation that will determine the pace of the global transition and also open new pathways for sustainable economic growth. So in today's discussions, we're going to take a close look at recent numbers, where financing gaps remain and how public and private capital can work together to unlock scale and impact. So I'm very delighted to be joined by an exceptional group of speakers today who bring a wealth of experience and insight from across the climate finance ecosystem. We have with us today Andrew Johnson, who is the Director and CEO at Climate Funds Managers, Disa Mafira, our very own Director of CPI Indonesia, and Sergio Guzmão Suchodolski, who is the CEO of Pharma Recapital, and I have to say that also the Senior Advisor at CPI Brazil. So together we will unpack how emerging markets are shaping the future of climate finance and opportunities to translate ambition into action on the road to COP30 and beyond. So please, if you have questions throughout this hour here, please keep them coming in the QA box. We will try to cover all of them, both in the chat and directly from our panelists, and otherwise we'll try to get back to you afterwards. But with that, again, welcome to today's webinar, and let me hand over to our very own Baisa to present the findings from our latest research. Baisa, the floor is yours.
Thank you. Thank you very much, Barbara. Following the excellent scene setting by Barbara, I'm very pleased to present the key findings from our report. To straight dive into our headline figures, climate finance to emerging markets and developing economies reached over $1 trillion in 2023. So that is almost half of global climate finance flows. So, but something to note is it's primarily driven by China, accounting for 64% or $685 billion in 2023. So for those who wonder what exactly we track, a very quick clarification. CPI tracks primary investment in physical assets and activities with direct and indirect mitigation and adaptation outcomes. So you can almost think that we don't necessarily track anything related to ESG stocks or wider secondary sustainable finance market flows. So our methodologies are carefully designed to present comparable and non-double counted figures, and we have detailed methodology document attached to our global report for those who are interested. So as Barbara mentioned, emerging markets and developed economies represent a large and diverse part of the world in over 150 countries. So when analyzing the trends, we thought that we should divide them into different subgroups so we can really unpack the trends across the different developed economies. So that is China, emerging markets, and least developed countries. And we also look into small island developing states. So, for example, in emerging markets, these basically exclude China and least developed countries, and there are about over 110 countries representing over half of the global population and 23% of global GDP. And the latest data shows that the flows reached $336 billion in 2023. Whereas with the LDCs, they include 45 countries, and they include, for example, 20 of the world's 25 most vulnerable countries. And the flows in LDCs reached $45 billion in 2023. And of course, we discussed China separately in our reports, as you can see, due to relatively big size, both in terms of economy and market, and also global leadership in climate finance. So looking at the relative speed of climate finance increase across these different subgroups, we see that China and small island development states seem to have the fastest growth, but for SIDS, it's important to note that they are growing from a very low base, which is only 4.4 billion in 2018. So while we see growth in emerging markets, they're still below global average, and there's a big disparity within the emerging market countries. But what we see in the EMDs is that they are really leveraging the low carbon transition as an opportunity to stimulate durable economic development. So this drives economic diversification, job creation, energy access, and better health outcomes while building over fiscal resilience. So moving on, we see the sources of finance, so where the money is coming from. So whether it's from public and private sources or international domestic sources. So this can give us an indication of market maturity on one hand, and then on the other hand, really understand who is playing a key role in driving finance in different parts of the world. So over 80% overall is driven by domestic sources. But this trend again is due to dominance of China. But if we exclude China, so flows from domestic sources accounted for 51% of flows in emerging markets. So that is about $172 billion. And we also see some uptick in the share of private international finance in emerging markets in most recent years. So you can see in this graph, for example, the international private sources increasing from 9% in 2018 to 13% in 2023. In LDCs, however, we see more flows from international sources dominated by public international climate finance. So only 17% of flows in LDCs is domestic. So LDCs still highly dependent on international public sources of finance. So this is our comprehensive EMD, Emerging Markets and Developing Economies, Sankey, or we like to say spaghetti diagram of climate finance flows. So what this shows is that it shows sources, instruments, uses, and EMD subgroups, as well as sectors to which climate finance is going. So overall, public and private sources are almost equal, but private sources are slightly higher at 55%. So here we're seeing, for example, more and more that households, small individual business decisions have a very important impact on climate finance flows in EMDs. And what's interesting is that how households are really taking matters into their own hands. So for example, electric 2- and 3-wheelers, right? So they are growing rapidly due to their affordability and low running costs compared to conventional engine vehicles. And we also see that distributed energy systems are becoming more affordable. So they provide secure and affordable energy sources for households. So we can really see that when the conditions are right, when the technology becomes affordable and the latest technological innovation is based on low emissions models, there is a demand, and the market will really embrace this trend. Sorry, one more thing, just to clarify on the public finance, national development financial institutions or public domestic banks also play a very important role in mobilizing climate and development finance in EMDs. Right, so moving on to mitigation finance trends. So here we'll unpack more of sort of mitigation finance, excluding China. So mitigation flows in emerging markets followed the global trend, with majority flowing to energy, transport, and buildings and infrastructure sectors. So they all kind of tend to have clear emission reduction potential and quantifiable revenue streams. And domestic finance accounted for almost 60% of flows in emerging markets most lately, and private actors accounting for the bulk of these flows. So countries that lead this trend include India, Turkey, and Brazil, among others. So most of these increases that you can see at this sector level are generally led by a few countries in each regions, right? So like, for example, in Latin America, we see that Brazil and Chile is really dominating. In Middle East, we see Saudi Arabia, Qatar, and Morocco, and Egypt. So if you really pick different regions, there will be like very handful of countries leading majority of the trend. So mitigation finance for energy systems, for example, more than doubled from 2018 to 2023, and it reached 156 billion most lately. So here, the biggest trend driver is the solar PV. And we all know that Global South has high solar irradiance, and solar is basically the most affordable source of energy. And what's remarkable is that technology costs are continuing to reduce, including for smaller systems and enabling expansion of off-grid systems. So many of these Sunbelt countries are really benefiting from this trend. The other thing to highlight is that when we see investments increasing, we are also noticing that countries have enabled private actors, including corporates or commercial financial institutions, to operate at scale. And there's a lot of policy work in the background. So there are policies related to feed-in tariffs, for example, net metering systems, whatnot. So all of these different countries have a lot of different policy elements embedded, and we have included a lot of case studies throughout in our report. So in terms of LDCs, so we see that mitigation finance increased from 14 billion in 2018 to 21 billion in 2023. So LDCs are quite unique in their development challenges. So it's both about energy access. Many of the population in LDCs actually lack energy access. So in terms of trends, we see that Bangladesh and Angola accounted for a large portion of increase in mitigation finance. And across LDCs, as I mentioned before, international public institutions remain the primary source of mitigation finance, providing more than half of total flows in 2023. And they are primarily like these kind of large-scale projects. So, for example, in Angola, we see a really large hydroelectric power. In Bangladesh, there are large projects around mass rapid transit, etc. So comparing the mitigation finance flows with the needs, we see that there, of course, like the ratio of flows against the needs are persistent throughout all of the sectors. But as you can see in this graph, we see that, for example, agri-food systems, industry, and waste have large climate investment deficits. But and we also see that agri-food systems saw minimal declines in emissions most lately, and it's due to lack of investment. So these sectors really require stronger financing mechanisms to mobilize capital at scale, as their mitigation outcomes are quite nuanced and it's quite hard to track. So moving on to adaptation finance. Again, we're excluding trends in China just for this session. So adaptation finance to emerging markets, so that's excluding China and LDCs, more than doubled from 2018 to 2023. And the latest figures show that it reached 27 billion. And most of these flows were across three categories, so other and cross-sectoral, water and wastewater, and AFOLU. So cross-sectoral solutions, for example, include disaster risk management and policy capacity building support. Just on the disaster risk management, we see that the DRM funding has doubled in emerging markets since 2019. And activities that we capture in our database include things like early warning systems and forecasting, risk monitoring systems, and support to resilience management policies. And we are sort of seeing in the news and day-to-day that adaptation is a real impact. It's a reality of today. So adaptation finance really tackles already the day-to-day climate impacts, and they have immediate benefits. Many countries have mainstreamed adaptation into national development goals, but now these broad climate objectives really need to be translated into deliverables and projects. So adaptation finance to LDCs and SIDS almost doubled from 2018 to 2023. But again, it's growing from quite a low base. International public sources account for almost all of these flows. And in many of these cases, fluctuations in adaptation finance to LDCs and SIDS partly reflect the small overall volume of flows. And because the total amounts are low, and if there are some large projects in 1 year, you can see these noticeable spikes and drops. So adaptation finance to these highly vulnerable regions must scale up significantly to meet the pressing needs. So one final slide on adaptation finance is that LDCs and SIDS the finance is provided primarily from concessional and development sources. So market rate financing has remained modest in both groups. Yeah, I mean, it's quite important to track these trends because they have, on one hand, high exposure to climate risks and therefore constrained fiscal space. So these countries really need to steer the climate adaptation challenge as well as the debt trap and work toward building resilient, sustainable financing portfolios. So moving on to international climate finance. So that will be the final section of this presentation. So cross-border climate finance to EMDs nearly doubled between 2018 and 2023. So now in 2023, it reached about 200 billion as of 2023. So we're seeing growing private sector involvement. So it's almost 50 billion. But still, public sources provided the majority, about 160 billion in 2023. And just a few words about the private finance in emerging markets and developing economies. Governments, as well as the international institutions, are increasingly working together to build trust in EMDs through greater regulatory and policy transparency. They also work to build strong institutional frameworks, clear accountability mechanisms. So as these conditions improve, commercial financial institutions are more willing to commit capital to various projects and, for example, renewable energy projects. And there is a large cohort of investors willing and looking for opportunities in emerging markets. So attracting this private investment is also very important in the context where the public budgets are shrinking around the world. So finally, South-South flows. It's becoming an increasingly important source of international climate finance for EMDs. So whether it's channeled through bilateral financing, MDBs, regional development banks, and South-South cooperation can really benefit for both recipient and the funder. So it's not just the finance flows, but there's a lot of knowledge transfer, know-how, and trade and development, and it's all built on the sort of the global shared agenda on one hand, but also shared challenges faced by the regions in the global south. And there are like very different types of cooperation, but what we've captured in our data, as you can see here, is mainly flows from sort of regional development banks. But going forward for South-South flows, we need better transparency on low carbon trade flows. So many businesses we know that are also using it as a business expansion strategy, companies. So for example, if one corporation led renewable energy projects in their home country, they can expand to neighboring countries to expand their business, for example. Yeah, and finally, I will wrap up with the key recommendations coming out of our report. So to summarize, a handful of countries are leading the way, and they're demonstrating the potential to mobilize domestic resources and also attract international capital. But there are still lots of sectoral barriers, and we still need to work a long way to close the investment gap. So on one hand, we need to further increase climate finance and its impact. We need to redirect climate negative flows. And also we need to increase the number of countries making this progress. So building on that, the three levers, solution levers that we focus on is one, strengthening domestic enabling environment. It's really crucial. And we've seen in our reports that that's exactly how countries are able to attract more capital. And then the second one is enhancing the quality of international climate finance to really make sure it's having the transformational impact and it's going to where it's needed the most. And then the third of all, the climate-related data is really going to enable more work and more collaboration in this space, therefore increasing the transparency, accessibility, and affordability of climate-related data is really going to be crucial. So that's it from my side. I'm looking forward to questions from you and the panel discussions. Over to you, Barbara. Thank you.
Fantastic. Thank you so much, Baisa, and thank you and the whole team for all the work here. And thanks to many of you who have already shared questions in the Q&A box. Please keep them coming again. I'll give Baisa a chance to get back and clarify some of the points that we are not able to immediately address in the chat box. But I think in the interest of time, I'd like to move to our panel. I think we've heard some really exciting news. I think just like my highlights from the presentation, certainly that flows to climate finance to emerging markets have more than doubled over the last 6 years. We are now at 1.1 trillion, which is more than half of global climate finance. So I think this is something positive. 55% private. Obviously, China is a big driver. It's the engine between much of that, but also of helping to really reduce the cost of capital. But then the important roles of policies, of public development banks, of partnerships with the private sector. So I think lots to unpack here. And so let me dive right into it. And I think we'll probably get rid of the slides for now so we can see our panelists here. Fantastic. Thank you so much. So Andrew, let me jump right to you again. I think Baisa has very clearly shown, obviously, that public finance continues to provide the backbone, the main part of international climate finance flows. But we've seen kind of a small but increasing also kind of share of private finance. But obviously, we all know that we are not in the easiest time in terms of public international finance. There is tighter fiscal space. So I think everyone here is working about how can we use public capital more effectively to attract private investment, and who, if not you, has a lot of experience in this space, apart from structuring blended finance vehicles, obviously lots of other experiences. So I'd love to hear from you a little bit how you see public capital evolving, the role of public capital, and what approaches can be best in unlocking private capital at scale across emerging markets. Over to you.
Sure, Barbara. Well, thank you, and thanks for the opportunity to join this this discussion, and compliments on yet another high quality report from CPI. That was my favorites. So yes, you're absolutely right. There's still a dependency on public financing for many aspects of emerging markets, and specifically in the area of adaptation, where revenue models are still nascent in terms of the investment arena. So there's much of a dependency still on catalytic capital to pave the way and to establish demonstration effects for other forms of capital. In many instances, these come together into what's called blended finance. And blended finance really is a technique which seeks to use that scarce public capital to mobilize the large-scale private sector at scale. Now, the important thing about this really is that the use of that public sector capital, which is indeed very scarce and getting less and less in terms of the proportion of available capital, is used in a tactical manner such that it sort of acts on the bleeding edge of the investment horizon. So you've got the bleeding edge, you've got the leading edge, and then you've got the core. It's important that enabling public sector capital is used on the bleeding edge, which then requires it almost to revolve. So it's important that these investments are structured in a manner that that capital can be returned back to the provider of that capital or into funds or some other interim holding pattern until it can be redeployed into another asset. So recycling is important. A continuous focus on adaptation is important, and although the private sector is looking into it, it's still an area, as I say, where revenue models are fairly scarce. And finally, I think where the public resources, and I use capital in a broad sense, should be deployed or increasingly be deployed, is actually using balance sheets, sovereign balance sheets, which are larger than cash availability. So things like unfunded instruments, guarantees, insurance instruments, that too can take the sharp edge off, on the one hand, pricing, but also importantly, taking risk out of the equation of how to deploy capital. So I think this trend will continue. I see positive directions, bottom left to top right, but clearly more work needs to be done, and with greater urgency and pace.
Fantastic. Thanks so much, Andrew. And I love the bleeding edge. I think certainly something to keep in mind. But I think that the point you made that really focus it on where it's needed most and really help take off the risks that private sector can't take it or is not comfortable taking it, I think is extremely important. And again, you obviously are leading some of the specific examples, the vehicles that are out there, which I think is important for everyone to understand. This is private adaptation finance is not utopia. It's something that is happening. I think it's really important to share that with the broader audience, because we need to build on experiences. And I love your point also around redeploying, recycling, and thinking more about guarantees, which certainly are still an underutilized tool here. But I'm sure we'll come back to that. But let me, Tisa, come to you and just get a little bit into a specific country immediately, into Indonesia. And obviously, I think everyone here knows that Indonesia has made quite a remarkable progress in operationalizing its climate policies, but also the broader transition that it's planning. There's a number of initiatives. Obviously, everyone knows about the JETP, the Just Energy Transition Partnerships, but there is also the energy transition mechanism, which you're quite involved in. So I'd love to hear from you a little bit. What are some of the most critical, let's say, levers in turning policies that into real actual financial flows on the ground? And is there anything specific you'd like maybe other emerging markets to take from Indonesia's experiences?
Yes, sure. Thank you. Thank you, Barbara. I think the main crucial thing is to have country platforms built within a particular jurisdiction, and that it's a country-led country platform. I think it's crucial for the government to have ownership. It's crucial for alignment with regulations and coordination of multiple stakeholders, and that's what the Just Energy Transition Partnership has brought to the table. Baisa was saying earlier that we're seeing a lot more EMDE governments working closer with financial institutions. And we are actually seeing that in Indonesia. We've seen that actually happen. initiatives like the JETP and ETM have brought forth more intense collaborations, closer conversations, better understanding of what each party is seeking. And you asked about, lessons learned, and I would like to give 3 examples of progress that we've seen. The first is that we're seeing a lot more diversified project pipelines being brought to light and being visible to financiers. So for example, for the JETP, there's projects that are owned by the state utility, projects that are open to independent power producers, projects that are community-based, multiple ticket sizes, big, small projects. And for other platforms in Indonesia, like the Environmental Fund Agency, they have diversified projects from land use to renewable energy to social impact projects. And so this provides like more of a pool, like a portfolio of options for financiers to look at. The second is that we've seen enabling policies becoming more apparent and the government more willing to talk about policy reform. So for example, the JETP managed to push for Indonesia's sustainable taxonomy to acknowledge a early coal retirement, right? Also managed to push for Indonesia to relax its local content requirement for renewable energy technology to be set up in Indonesia. So this is progress that wouldn't have happened without the JETP. And lastly, I wanted to talk about how important it is for country platforms to be able to pool funds and blend finance at the pool level. And all of these 3, examples that I've given are imperfect. They're work in progress. We're seeing progress in that direction. There certainly can be more homework to do, but it's very clear that the country platforms set up by the country have been the main drivers behind this progress.
Fantastic. Thanks so much, Tisa. And yeah, I think some really good lessons, but I think certainly what you're sharing is that we are going much more granular now. There's much more experience. There's really something is happening, which I think is exciting. And I've been just to Indonesia a few weeks ago, and I was very impressed by really the openness to talk about early coal retirement, which I think is something that would not have happened some time ago. So I think that, and focusing on the pipeline, really not just talking about, in big abstract terms about financial flows, but really what is out there. How can we direct more blended finance also through the right enabling environment towards the right pipeline, I think is critical. But let me come, Sergio, to another country. Certainly all eyes on Brazil, not only this year, but this year particularly. I think Brazil is certainly, or has emerged as a regional leader in mobilizing capital for climate and more broadly for sustainable development. And I think we certainly can see this growing momentum across both public and private sectors in Brazil. And obviously you bring a lot of experience, both from leading regional development banks, which Paisa has highlighted is obviously public development, a key driver here, but obviously now also as the CEO of more private side. So I'd love to hear from you a little bit. We've heard more about like maybe more innovative ways or like ways to think about how can you blend types of capital, but what are some of the more effective strategies that you can think of that could help turn this current momentum into some more larger scale investable opportunity, which ultimately hopefully can both attract domestic and international capital. The floor is yours.
Thank you, Barbara. Such a pleasure to join you today. Congratulating all the team for a wonderful report. I really had a lot of pleasure and enjoyment as I was reading it in preparation for today. So kudos to Paisa and all the team, and it's an honor to join you, Andrew, and Tisa on this special occasion. So indeed, if we just take a step back, looking at my specifically my region, specifically Brazil and Latam, in the run-up to COP, we need to look at some of the programs that have been created, and Taisa made reference to country platform, which especially the ones that are led by the country themselves, and it's the case for Brazil. as I would say, we have enhanced our country platform, perhaps building on the opportunities that the G20 created last year, and then again this year, COP30, but also the BRICS, Brazil's presidency leading the BRICS, and also leading the BRICS Bank, the new development bank, under the leadership of a Brazilian, and also the leadership of a Brazilian at the Inter-American Development Bank. So with that in context, and then trying to give some color to the findings in the report, we can look back and sort of take stock of originate to share IDB program and the strategy to really scale up climate finance, right? That started a few years back, but already under the leadership of Elon Goldfein. So we're looking around 3 years back. And then in the run-up to COP and G20, the Amazon Forever fund. And then again, the Eco-Invest and the Brazilian investment platform, right? So, and then again, the Brazilian Congress approving the carbon markets regulatory framework. So we see a lot of action and concrete regulatory programs in place in this run up to COP that have been mobilizing very relevant pools of capital. And then again, with the new Reinvest program launched by IDB, you create additional sources of unlocking private capital, especially in local banks, to reinvest in the whole region. This has been followed by a number of recent RFPs in which both domestic and international investment platforms, investment funds like the ones that I lead, have been bidding, sometimes in partnership with international folks. So what we are already seeing is this increase of flows that I think the report start capturing. If we look, of course, at sort of a global flows of capital and compare it to the advanced economies, is still very small. Okay, and we can even reference the figures from the global CPI report from last year, where LATAM, that's kind of leading here if we look at emerging markets, but in the global flows in 2024 is only 5%. So of course, sort of in relative terms, it's still small. There is still a large gap, but definitely we have, I think, the tools to scale up and increase, and not only the programs that are already mentioned in the country platforms and sort of the visibility, and I would even say the more advanced stage of capital markets in Brazil and the financial system in general. But I would say that there will be an even larger increase that will only be captured by 2026 report, because some of these programs, in terms of the actual investments, commitments, they will only take place in the beginning, at the end of 2025 and 2026, because these are products of the country platforms, but where the results of the RFPs have not yet have been announced. So I think it's good news, because we will see that graphic increasing further, especially when we take into consideration also the flows for mitigation and adaptation. I think this is a very interesting part of the report in terms of really looking at the two investable universes, and also some critical events that took place, especially in Brazil. We had many critical events in terms of flooding and very intensive rain, doing a lot of damage, including in Efulu, which is one of the areas that it's covered by the report, and also relevant urban areas, and the reinvesting, rebuilding of these areas is already, and the infrastructure around them, it's already taking into account the climate effect. And by that I mean that they will certainly be rebuilt under under a methodology of adaptation, right? This is already expected. This is already underway. So in general, what I see is a great opportunity for international investors, private investors, to be involved in those sectors. Thank you.
Fantastic. Thank you so much, Sergio, for really showcasing that what I feel is a very impressive series of concrete initiatives that Brazil has been taking, both for Brazil but also for the region. Clearly walking the talk here, but I think it's also good to kind of point and connect it with some of the actual disasters that are happening. And again, what Bryce has shown, that at least we can see disaster risk management investments also increasing, which I think is probably linked to that. But certainly we will have to do more, and we will certainly continue to track. But I like your final point on ending, that there is a lot of opportunity. And I'd love Andrew actually to come back to you. Just a heads up, Tiso, there is a question for you then to see whether the models that you've been mentioning for financing, whether they're also replicable in other countries. So if there's anything you'd like to share once I come back to you from your first round. But Andrew, again, talking about referring to the opportunities that obviously Sergio has mentioned, but I think that we also our data is showing that emerging markets are using the low carbon transition to really drive industrial diversification, more jobs, fiscal resilience. So just from your perspective, from an investor's perspective, where do you see kind of the largest opportunities for growth in emerging markets?
So, Barbara, you're right. Decarbonisation and industrialization are starting to merge, and it's quite interesting because I've been an infrastructure investor for now coming almost 30 years. And I remember in the Infrastructure 101 handbook, it was really a very benign asset. It was something that nobody really knew about it. It was off the radar. It was pretty exclusive for pension funds, and its purpose was actually to support GDP growth. It was an economic asset. And then over time, it evolved with the establishment of performance standards, awareness of ESG. It became then a social asset, it became an impact asset, and it evolved around about 2015 or so into a climate asset. And now it's almost gone a full cycle back to being an economic asset. It's got footprints of all of the journey it's gone on, but it's right back to where it sort of started, which is it's an industrial economic support asset. And so it's quite ironic 30 years later, we to an extent end up where we started. But in that journey, it's picked up some friends along the way, because as the world has become more aware of the significance of climate change, and indeed those areas of intervention that talk to the planetary limits, of which decarbonisation is one, so we start seeing the overlapping of global themes. So things that traditionally used to be climate and other are now converging into climate. And so it's quite conceivable that within a relatively short period of time, every asset will be seen through the lens of climate and will become a climate asset. And we are seeing this. So your report is highlighting that many of the applications of this type of capital is real assets. It's buildings, it's wind farms, it's water assets, but it's real bricks and mortar infrastructure. We are seeing a convergence, however, and that's a type of financing which used to come in the form of project financing or blended financing. We're now seeing a convergence of that with technology. And so when you talk here, and the significance of that is, as we think about supply chains and dependency of supply chains, if you're going to build a transmission line to accommodate increased renewable energy on the grid, you've also got to think about where do the cables come from, where do the substations come from, where do the control systems come from. So you start looking all the way down the value chain, and this is typically you've been in the realm of other forms of financing. It's been private equity, or it's been corporate financing, but blended finance and climate finance is moving into that realm as well. So it's almost as if what used to be Venn diagrams that had a degree of overlap are now turning into sort of a layered cake where everything lies on top of each other. So, and answer your question, where's the opportunity? Well, it's down the value chains of what used to be core infrastructure. We're seeing investment opportunities where we currently invest in things like waste to energy. We're seeing opportunities actually in the biodigester sector. So go downstream, look at the manufacturing, look at the equipment supply, and opportunities there. Not only does it make sense because you then have an integrated supply chain, which were tested quite significantly in COVID, and so you want to keep your suppliers closer, you want to know where they are, and you want to be able to integrate them closer than was the past. But also, it's where opportunities are. Opportunities are where there is sort of a supply-demand imbalance, and it might not necessarily be in the obvious places. It might be in the less obvious places in the supply chains. Final area is that infrastructure and climate financing used to be very project specific. Go and build something. We're now seeing the evolution of enterprises. So in addition to buying or developing the underlying asset, you invest in the ecosystem that develop the asset. So platforms, so commercial industrial platforms, distribution and mini grids, rural electrification. So you see the aggregation of assets into enterprises, into businesses, and they give interesting angles to them because they tend to have more liquidity, they have greater scale. So it really is those would be where I'd say infrastructure, technology associated infrastructure, and enterprises that are starting in emerging markets that can benefit from tools and technologies and skills from the more developed markets.
Fantastic. Thank you so much. And I think that all is actually very encouraging because I feel that there's even more opportunities that you see kind of at first glance. So I think how you're taking us through and really thinking, as you said, it's a little ironic that we're actually coming back, the climate development, nature, health, economic transformation, ecosystem is all coming back together. But I very much like your points and also thinking more, and I think that comes back to the scale point. Also, how can you go from retail to wholesale? How can you really go towards the ecosystem perspective, the enterprises perspective that you highlighted? But maybe actually, Tisa, that brings me nicely to you because as there are so many opportunities, I feel like very often, and again, our data shows it actually, that countries themselves are realizing and that there are opportunities. Again, our data shows that 80% of all climate finance is raised and spent in the same countries. That's domestic. So that is clearly an opportunities that countries see. So, but obviously at the same time, we've talked about other sectors like adaptation. We know we still need this international climate finance as well. So love to hear from you a little bit. And then obviously feel free also to reply to the other question related to your previous point. But I'd love to see from you a little bit, how do you see the right balance between strengthening, domestic financial ecosystem, but also attracting some well-targeted international capital that can support some of this local ownership?
Yeah, I mean, this is great number, right? 80% of climate finance coming from domestic sources. I was certainly very happy to see that because often you see these when in public discourse, it's EMDE saying, where's the money from developing countries? And developing countries saying, that we're trying to get to 1.3, it's difficult to get there. But amidst all of this talk, action is already happening on the ground, and the EMDEs are actually spending because of the need and the ability to spend, and the sense of urgency that they need to spend, right? So I view it as a strength, right? Looking at how climate finance comes from domestic sources shows that depending on domestic sources is a strength. It shows self-security, it shows self-sufficiency, and a willingness to take climate action despite limited international support. Now, of course, international capital is still in high demand. These are fast growing markets. These are countries with growth targets of 5%, 8% for the case of Indonesia, of GDP growth, right? So there's a huge demand for international capital, which will come in through different sources. So we need to parse, in order to see if effective and impactful international capital, we need to parse what is the type of international capital that we're seeing that's coming in, and what should they be used for in order not to crowd out other sources of finance. So for example, commercial foreign direct investment, that provides much needed liquidity. We love it when they come in as a syndicated effort together with local banks. We see that quite a lot, especially in energy transition projects, which means that the local banks are also kind of expanding their market base together with the international banks that are coming in. If it's concessional funding, they're providing much needed de-risking, preferably coming in not to compete against commercial finance, but to leverage commercial finance. I saw a question as well on whether we've seen the crowding out of private finance. We have unfortunately. And so we're always saying, encouraging development finance, concessional finance to focus more on non-commercial projects, non-bankable projects, right? The other thing that we see, of course, is the need for more finance flowing to adaptation projects that may not have revenue projections, projects that will find it difficult to prove themselves bankable. That definitely needs a lot of development finance aid from international sources. So once we see this mapping of like which funding is matched for which kinds of projects, we can actually visualize what an ideal match making between these funds and these projects could be. So to answer, the question on diversified models for financing, I think that's still a work in progress, right? We do need to see more discussions between different financial institutions on how they can work together, because otherwise it's the country that bears the transaction costs of figuring out, okay, what is Germany going to give us? What kinds of rate? Okay, what is the UK? What is the US trying to give us? What are their requirements? What's GFAN's going to give us? What are their requirements? It becomes the burden of the government, which we saw actually happen in JETP, because the funding at the top did not organize themselves and pool themselves in a syndicated fashion. So in order to innovate and diversify in the finance supply perspective, the different FIs need to talk to each other more frequently and figure out what it is that they're best suited for and what it is that they can do together more effectively, so that the rollout of innovative finance, the rollout of de-risking instruments and blended finance can be done in more of a kind of a plug and play fashion instead of having to be bespoke and tailored each and every time.
Absolutely. Thanks so much, Keith. I think extremely helpful. And again, I would say there's lots of lessons from all the experiences. Certainly the JETP, I think, has provided lots of lessons. I think your point on, we just really start at the country level, understand the needs that the country has and the types of capital the country needs for specific sectors or specific kind of technologies that it needs to really get to its own targets and again its own development priorities. So I think having that much more nuanced will allow you really to kind of come up with like replicable models that then can get us to scale. I think certainly too much complicated and bespoke approaches that have been used in the past. So extremely helpful work in progress, but at the same time, I think lots of very helpful lessons. But Sergio, let me come to you again. Brazil taking the center stage this like COP in a couple of weeks only. So I'd love to hear just also building, I think, a little bit on what those NNTs have said with their experiences, both in Indonesia and South Africa, just understanding what are some of the key steps that you think both Brazil, but also other emerging markets should be prioritizing. Clearly, there's a kind of whole wish box toolbox of things we should be doing, but what would you think we should prioritize right now?
Well, thank you, Barbara. I think one topic that is very relevant here, and we sort of referenced in colleagues as well, is the global South, especially South-South cooperation and investments and trade flows. And I think what we see today is that this is becoming more concrete reality if we look at the figures. And it's interesting that we have Tisa here from Indonesia. I was in Indonesia this year, and the past year I've been 5 times to the country. I was also in South Africa earlier on this year, together with Andrew and Barbara and others. But I think in the case of Indonesia, President Lula, Brazilian president, just came back from Indonesia, where he was last week, and a number of initiatives are underway where Indonesia and Brazil are playing a key role together. Of course, we need to reference directly the Tropical Forever Fund, Tropical Forest Forever Fund, the TFFF, which is a joint initiative by both countries. So this is an initiative that it's anchored by Indonesia and Brazil, and it's one of the most relevant deliverables of COP30. There will be a ceremony during COP30 for the sort of the following the announcement that took place during the UN General Assembly in New York. There are joint initiatives in biofuels together by Brazil and Indonesia. There are joint efforts of decarbonization of shipping that are underway in the International Maritime Organization that are led by the two countries. And the trade between Brazil and Indonesia is already considered to be among the 20 most relevant trading partners of Brazil. That means that Indonesia is ahead of many European countries when we look at the trade flow. I know there are also investment agreements underway, including between the Indonesian sovereign wealth funds and other entities here in Brazil. So this is becoming ever more relevant and concrete. Before you would say, oh, this is more kind of a political initiative. This looks a little bit like non-aligned movement. But today, I think we look at them and it's very concrete. It's in areas where we can see that there are similarities, that there is, really underlying assets that make sense in terms of, in investable assets, in terms of, complementary trade flows and general interest as well. And I would say the same for South Africa. I'm just referencing Indonesia because this is very recent. It's just news coming from last week and which are related also to COP30 as you mentioned, but there are a number of other collaborations between Brazil and South Africa, especially also in the DFI sector between DBSA and BNDES and country platforms and many other sectors as well. So I think this is a very interesting and relevant point to be looked upon if we look at the report and the advancements that we see in emerging economies. Thank you.
Thank you so much, Sergio. Again, super helpful. And again, I think very encouraging just to see all what is going on. And certainly, I think lots of things that we all hope will come up in COP, but also beyond. And I'm certainly very encouraged by what I've heard from the panel here. Just before summarizing, Baisa, let me give the floor to you just for any. I know there's lots of questions, and thank you all so much for contributing questions in our Q&A box. But Baisa, over to you to reflect on a few of them.
Thanks a lot, Barbara. I've just picked a couple of questions in the chat, and I'll reflect on the transparency and the geopolitics related questions. So just on the transparency, it's extremely important to keep track of climate finance flows, and CPI has been doing this for over 10 years, and we've been primarily relying on publicly available data as well as the transparency led by the public and private institutions themselves. So it's done through a variety of methods, through paid subscriptions, through disclosures, etc. Right, but it still remains a challenge, and from our perspective, this information is so important to global progress and discussions, and we're always supporting any sort of initiatives around transparency, specifically on climate finance flows. So the other point, just around the geopolitics, again, it's becoming a really big question given the political environment, but from the data on the investment, we see that despite all these headwinds, the projects, the financing to renewables are still going. It's more of a matter of reallocation from one region to another. So, for example, from US to more to the Europe, but where the investments are making money and return, there will be private investment. So that's it from my side. Thank you, Barbara.
Thank you so much, Maisa. I am going to break the rules here, and I'm going to ask every panelist for just one word on, we all have our wish lists for COP and beyond, but if there's one thing that one word, one commitment that you could wish for that should happen, or one priority area, what would it be? And Andrew, I'm starting with you.
Okay. Clear and actionable NDCs.
Lisa.
The Baku to Belém roadmap achieving 1.3 trillion a year.
We all have very long words. Sergio.
I think the voices of the developing world being heard out loud.
Fantastic. Thank you so much to my panel here. Let me very quickly just try to summarize, I think, a very rich discussion triggered by the excellent work Maisa and team have been leading. Very excited. I do want to just recall the key figures here. The climate finance to emerging markets more than doubled over the last 6 years. We are now at $1.1 trillion, 55% of which is private and 80% of which is domestic. I think these are important figures to keep in mind. This is progress in the direct direction. Obviously, we still have to do much more, but it is a really important progress. I think what I've heard from the panel here is a lot is happening. There is success in many areas. We are getting much more granular on what is happening. But obviously, we know that we need to build on what's been done and make sure that it's replicable and scalable, and really go from retail to wholesale. I think, how do we do that? I think I've heard a lot from the panel here to focus the more scarce or the public capital more on areas like adaptation, but leveraging and not crowding out other pools of capital. Innovation still focusing on the bleeding edge, not the leading edge, thinking about recycling of sovereign balance sheets, liquidity, how to build and originate to distribute. Ownership, really ensuring that all this is country-led, and really thinking how we're country-led with a much clearer and more intensive collaboration between actors, but also between countries. I think South-South collaboration is extremely important. And obviously, not last but least, the importance of enabling policies, regulations. I think very important also what Sergio mentioned, that there are the carbon market regulations, which is another really important revenue streams that we need to look at. I think I leave this discussion today encouraged. I do think we sometimes have to really think about, the successes that have been achieved and really build on them. Yes, we know that there's much more we need to do, but I think this is the biggest opportunity of our lifetime. So let's all work together to make sure that what happens, that what Andrew said, every asset will be a climate asset, is actually true. So thank you so much all, and let's focus on opportunities and work all together on that. So thank you very much. And there will be one last webinar in this series in December. Please join us for that one as well. But thanks so much to all my panelists and my team. Thank you.
Bye-bye,
Thank
Barbara.
you.
Thank you.
Barbara, thanks everyone.
Bye-bye.
Good evening.
Thank you.